The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, what another wild session we saw in the markets on Wednesday as President Trump's tariff pause rallied the markets late in the session with sharp gains in livestock and the outside markets and the soy complex and moderate gains in corn and wheat as well. We got to try and make sense of all of this headline news and really take a look at just what's happening in these markets when you think about charts and more. Let's talk about it. Joining us now, Mike Zuzolo with Global Commodity Analytics is with us here for analysis. And Mike, man, oh man, I told you when I walked away for lunch and came back and looked at the markets on Wednesday afternoon, I clearly knew something had happened because we went from mixed on the session to sharply higher with just the matter of a Truth Social post, Mike.
It's hard to even go to the bathroom at this point, Jesse, without missing something. I mean, it's really getting intense. And, you know, the big point of today is for me, why did the White House move so aggressively, isolating China by taking their tariffs up to 125% and going back to the baseline tariffs of 10% on all other countries? And I think that even includes Canada. And I think you can read a few things now that I think we've talked some about this, thought that this may be the case, but now we have some pretty conclusive evidence that if you don't know anything else, you can probably know now that the real cause of these tariffs and the real goal of these tariffs is to weaken the dollar and to specifically target China as both a financial economic threat and also a geopolitical threat. And I think that's where the heart and soul of where we're headed now, regardless of the new news that comes out each and every day, unless the US and China come to an agreement, that's probably the big feature that I'm going to focus on as we go into planting and get the next new crop planted here in the Northern Hemisphere.
Well, let's talk about some of this. I know you shared a few different graphics that we want to take a look at on the video feed. And let's start when it comes to U.S. ag goods, export by country, and things of that nature. And you mentioned specifically how it seems like we're kind of trying to box in China right now. That seems to be the big elephant in the room here by the Trump administration. Walk me through just what all of this kind of means when we look at ag exports and more, Mike.
Yeah, now keep in mind, this is in dollars. This is in farm receipts in dollars. And so the currency does matter in this. It's not about volume on this chart as far as when you look at, for instance, the beef exports of the amount of production that we send out to the world being about 20% of our farmer cash receipts. What this chart really shows me is the president's team was very smart in holding intact the North American trade and USMCA and choosing either one or the other, go after Mexico and Canada hard and leave China alone, or go after China hard and leave Mexico and Canada alone. Don't try and take all three on, because your major voting bloc, the American farmer and the manufacturing groups that are surrounding the American farmer in terms of the geographic locations, they could not have taking on all three of these major countries, these major trade partners in agriculture. And so now, after Wednesday, moving those tariffs up to 125% against China and then cutting back on Mexico and Canada, we can see that what should happen, and we know we're right ahead of a WASDE report on Thursday, a U.S. drought update on Thursday, and a weekly export sales report on Thursday. But what we can say right now on Wednesday afternoon is, theoretically, the soybeans, anything in green, is going to be hit the hardest at this stage of the game. And so we're talking about sorghum, cotton, soybeans. They really light up the board here when it comes to how much we sell to China as far as U.S. farm receipts. So to me, if you are looking at these markets as a farmer getting ready to plant, and especially if you're in the Tennessee River Valley, Ohio River Valley, a part of the Mississippi River Valley, and you're really wondering whether you're going to be able to get all those corn acres in and switching to beans, I would once again suggest to you, unless USDA comes out on the WASDE report and surprises us with a tightening of soybean production in Brazil and Argentina, it's probably wise to really think about, if we get another boost in these soybean commodities in the futures market, it's probably wise to get a floor underneath you in the next 30 to 60 days, because that's where we could have seen the biggest corn acreage number and the smallest soybean acreage number here in the States if this current weather pattern holds.
Well, and I want to look at this as well. You sent me over a tariff simulator from MIT, and I'll also make the comment here, with how much China, gets U.S. soybeans, but they've shifted a lot of their needs to South America, for instance. I found it, quite interesting that even with the higher tariff on China, that we saw beans up 20 cents into the close on Wednesday. And it's just, there's a lot of interesting dynamics at play in these markets right now, and especially on the soy side here, as you mentioned, acreage and more, Mike.
Yeah, I think that's an excellent point. I think that right there, Jesse, is to me, analytically speaking, and looking at this chart, which, as you say, comes from MIT. I ran this chart analysis when it was 84%. The MIT thing doesn't even go up to 125%. It tops out at 100. I'm sure they'll have to rewrite it now. But you see the biggest number out there is $12.5 billion in soybeans. Now, by my calculations, at $9.50 a bushel, that's about 1.3 billion bushels of soybeans that they will not take from the United States. And this is by year, so that's obviously not a good number, but it just shows you, and to your point, the beans going up right now. Yeah, Argentina is probably creating some meal short covering. Looks like we've got a base building in the meal complex at this stage of the game after the last few days of trade. But and we've got the oil products, the soybean oil products markets wondering about the sustainable aviation fuel and that big jump in the biodiesel fuel with EPA and USDA working together with the big oil and big energy. But I think it goes back to, can you offset the export market of China in the soybeans in any other market out there? And I'd say no, it's pretty unlikely, given the fact that we may have 170, 168 million metric tons of Brazilian soybeans. That would suggest to me they would have some extra bushels to go around the world as well. So this just kind of supports the point of the previous chart, that if we're talking about China, we're really talking about soybeans. And I'd say to a lesser degree, we're talking about the pork side of the equation too. One other point I would make here is one thing that came into my mind as far as why the original question, why the shift by the president on Wednesday. It could be that we either did not have a tax cut bill coming here in the United States, and we also may not have had any trade agreements with Japan and South Korea to ease the pain in the soy complex, in the beef, pork complexes, to offset what's going on with China. And then the other mysterious, more difficult, less transparent feature of this market is some of the people on Wall Street talking about the bond yields and how the bonds really performed badly in the overnight trade.
One quick thing that came to my mind, and I'm speculating a little bit here, but could the ultimate end game for the Trump administration be China as a whole, and everything else is all for show in some ways, Mike?
I wouldn't say it's for show, but I think I'm on the same path as you from the analysis. And, I listened to Jameson Greer's testimony on Tuesday. I've read several more publications from some of the key Trump administration officials and trade people. Greer, in his testimony, I have it right here, said very bluntly, the United States share of world manufacturing output declined from 28% in 2001 to 17% last year, meaning 2024. That's China, I think. I mean, you can say Vietnam, you can say a couple other countries, but really it's China building factories in Vietnam, China building factories in Mexico. I think, yeah, that's pretty much where we're headed. And that's also because of China being involved with Russia and Ukraine, China being involved with Iran, China being involved, obviously, in the Taiwan Strait. this is a geopolitical threat. And, Hassett also goes on to say, or excuse me, Greer also goes on to say, during World War II, we built nearly 9,000 ships. Last year, the United States built only 3 ocean-going vessels. Again, that's got the China fingerprint all over it. So I think your point is excellent.
Mike Zuzolo, Global Commodity Analytics, is our guest analyst here today on Market Talk. I want to talk about the currencies, the 10-year yield specifically here. And I know you have some interesting thoughts and analysis on this as we continue to watch this immense volatility. Walk me through some of what you're tracking when it comes to the 10-year and how it plays into the broader market picture.
Yeah, this is not a good chart. I mean, this is a daily chart, and you notice that the 10-year yields before the last 3 days had been dropping substantially and actually had gone below 4%. I think, Jesse, I can say at this point, if this plan is going to work for the commodity sector and agriculture especially, we've got to have a weak dollar, and we've got to have low interest rates. We've got to have low bond yields, because higher bond yields and higher interest rates, those equal a U.S. recession. And so if you have a strengthening dollar that makes our goods more expensive to export, and you have higher interest rates, and those two things usually go together, you've got a real problem on your hands with the plan that we've laid out at the White House. And what I had heard last night was the 10-year notes had suffered a tremendous amount of selling. And you can see it in the last 3 days. We've gone from just below 4% all the way up to 4.5 as of the overnight trade on Wednesday morning. And there is talk, there is rumor out there that Asia was selling, not necessarily China, but Japan and maybe South Korea and some other Asian partners that hold our debt. And that might have been a factor why the Secretary of Treasury came out on Wednesday afternoon and talked about this change in policy and this hold for 90 days. And so the stakes are really raised now, because you've really kind of opened up the Pandora's box. What if, and this is what I'm going to talk about Friday with my clients and subscribers after the USDA report, what if the bond yields keep going up even after this change in policy? That would be a very negative feature in this market. It would open up the downside in the commodities, if you ask me.
It's a very interesting thing to think about here, how all of this is going to play into the commodities and play a role here. And I want to ask you about December corn. Let's look at that seasonal chart, just as I'm thinking about, any sort of new crop marketing activity by producers. I've heard talk that there hasn't been a whole lot of new crop marketing done by folks here as of late. So when you look at, say, December corn, what stands out to you right now amid all this volatility, Mike?
I've heard the same thing, and I think it's fortunate because producers in the last 3 years have used an averaging program with their elevators in terms of selling cash corn, and those have worked fairly well from what my understanding is. But I think the producers pulled back on that. I think they were wise to do that, because that averaging right now is really tricky, and it's been really tough for the most part when it comes to what we've traded here in the last 30 or so days. What I like about this chart is I've picked out the key years that we had pretty close to the same price as we do right now, and then also what kind of price pattern we've had up to this point. And so the 5 years that I picked out, or the 4 other years that I picked out, and then the average of those years in white would suggest that this report can be pretty meaningful, because this report sets you up for what happens going into the 1st of May. And the 1st of May, middle of May, you notice you could have some pretty big jumps in the case of 2024 and 2009, and a really big jump in 2021 with that pandemic issue. But then you can also have some negative years like 2015. So I think this is where the South American crop size comes into play, Jesse. And specifically, do we see bigger bean production out of South America and smaller corn production? The trade right now, the average trade guess, I was surprised, putting it at 126 on the corn production number for Brazil, and that's where USDA was in March. I think you could be 125, maybe even 124. And I've seen lower numbers from other analysts in South America specifically. But I have a sense that the USDA WASDE numbers are going to play a big role in which way this trends in this December corn and which year this looks like in another 3 weeks.
Well, Mike, let's go over to the livestock sector and talk a bit in cattle. Sharp rally there on Wednesday. And let's look at the correlation. We've been looking at this here off and on between the S&P and the live cattle futures. And, this cattle market has really been, I think we talked about this a bit last week, really been moving with the stock market. So no surprise we saw a sharp rally in futures as we got that sharp rally in stocks amid the tariff news on Wednesday.
Yeah, and we did see before that, it was very good that we saw this change in the stock market price action, because before that we saw the negotiated cash trade go down from that 210, 211 level down to 206. And so I've been waiting to see, does the cash win out here and stay strong with April futures in delivery now, or getting ready to be in delivery now, and that being essentially the cash market at the mercantile exchange and being at $200. And that $10, $11 premium in the cash, does that make something of the cattle market? But you're right. This is where the cattle market in the last 4 weeks has really taken a turn and really started to play strongly in the same similar price action as the S&P 500 and the Dow Jones. And I don't look for that to change, because, when you see the S&P 500 and the Dow Jones lose what they've lost, you're hearing a lot of people talking about not flying, talking about not doing things, not sure if they're going to put their summer vacation plans on hold, that kind of thing. And I think that just goes directly back to the meat demand and summer grilling season and the restaurant demand here. So this chart once again becomes a very key element to the analysis. And what I'd like to see on the WASDE report on Thursday for grains and for meats is to not see a big drop in exports and not see a big increase in imports. That's one of the things that I will be watching.
How about that feeder fat spread? That's another thing we've been tracking quite a bit, and I know that's been kind of taking a beating here as of late with all the moves in these markets. What are you tracking with that spread action right now?
Yeah, I think the trade has decided that they would rather be in the feeders on the long side of the equation than the fats, because of Wall Street and because 7-weight feeder steers in South Dakota and the northern cattle belt still running 320, 315. So, I mean, there is still a lot of premium in the cash feeder market right now, Jesse. So I think that we took that dip into the mid 60s, low 60s feeders premium to fats as the the February went off the board on the fat cattle market. We started to see a change in the direction, and now we're back to over $80 premium in lead month feeders over fats. We're hitting records now again. So this is where you're pushing on a string. If you get upwards of $85, $90, that's probably the top end, would be my guess, for the feeder cattle market, unless the fats can join the ride and jump on board. This goes back to the hog market too, and what's going on with China, and whether we get some of these deals with other Asian countries or not. So I would say the grains actually look less volatile to me than the livestock does right now when you add Wall Street and Asia into the equation. And so I think these livestock markets could be very, very volatile the next several months.
Well, and thinking about that hog market a little more specifically as well, I should ask you about that for our hog producers with the China factor. I mean, that's an obvious one to me when, we see all these tariffs getting increased. China, such a huge customer of U.S. pork, but then, I think about Mexico, they're a big customer, and things have been somewhat friendly there. So, I mean, what are some of the impacts we really got to pay attention to? What are some of the key things to track in this hog market right now?
Yeah, two things. Number one, the offshore Chinese market, the offshore Chinese currency, I should say, made a record low a couple times this week. And so we are seeing the pressure put on their currency markets. That's pushing more deflation into their economy. They're talking about doing a big stimulus, like over $200 billion, maybe $300 billion in the not too distant future. I think those are the two things to be watching here, because if they don't do stimulus and the currency keeps weakening, I think their consumption is still going to be very bad domestically. The Chinese consumers are just not going to go out and buy, because they're going to be like the Western consumers. It's only going to get cheaper. I think at the end of the day, remember that what got us into this was 1985 and the idea in Japan that they were doing too well and they were taking too much of the world economy. and we asked them to increase their currency and devalue the US dollar. They did that willingly because they were a trade partner and an ally. We're asking the same thing of China now, and they're not doing that willingly.
Mike, great stuff as always. Anything final you'd share or reiterate for folks here today?
No, just keep the Pepsid and Dramamine handy.
That's a good way to put it. Well, hey, if folks have questions for you there at Global Commodity Analytics, what's the best way to reach you?
Best way is globalcomresearch.com, and it's globalcom with 2 M's, research.com. There's a 2-week free trial. I'll extend that to 3 weeks, given the times we're living in.
Mike Zuzolo, Global Commodity Analytics. Always good to hear from you, sir. Have a great week, and we will talk to you next week.
You too, Jesse. Thanks so much.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.